So one will be to review all the information provided by the directors, review all the information provided by the directors, in identifying all the non-related parties, identifying all the non-related parties, and then what the auditor does also, in line with knowing these related parties, he will review the management's procedures. So also review the management procedures that are used in identifying these related parties, for identifying related party transactions, and some of these transactions you're saying, for example, between a parent company and its subsidiary, the intergroup sales, that is what you're saying in this case. And then also, he can review the prior year working papers, for the names of the non-related parties, So these working papers will help him identify the related parties that were already highlighted by the previous auditor, and then also inquire as to the affiliation of the directors with other entities. So this is the kind of relationship the directors have with other entities. So these are some of the procedures that the auditor may use for identifying existence of related parties. And then also on the basis, so this is on the related parties. Now for the related party transactions, on the other hand, so this is to get the names of the related parties. And then for the related party transactions also, so for the related party transactions, the auditor, so this is to know the related parties. For example, these ones, joint ventures, parent company and the subsidiaries, the directors of the company, alongside others. So, and then for the related party transactions now, this auditor may review the minutes of the shareholders. Review the minutes of the shareholders. So the transactions that are undertaken by these related parties, about material transactions, authorized, because these transactions may not necessarily be carried out the same way as other transactions. Material transaction authorized by the board, and during those meetings. So these are some of the procedures that you will write in the case of such an exam, the related party transaction. And then for the related parties, also he can review the conflict of interest, the conflict of interest statements. So this is where the directors, if they have any interest in the contracts of the company, they have to disclose that interest, and it is highlighted in the conflict of interest. The conflict of interest received, that is what you're saying, received from the directors. So this is a very crucial item for the auditor to carry out an evaluation of. And then also review the extent and nature of the business. Review the extent and nature of the transactions conducted with the major customers of the nature of the business transacted with major customers, with major customers. This is to highlight the related party transactions, and then also consider whether the transactions are occurring without being given accounting recognition. Also can consider whether the transactions, whether these transactions are occurring without any form of accounting systems, without being given accounting recognition, So if you can recall, yesterday we talked about how to recognize this revenue, and this is what you're saying. So if these transactions are occurring without that basis of the recognition, then that will be an area you have to look at. And then also review the accounting records for any large unusual transactions. Review the accounting records, for unusual large transactions, So that is what you're saying. These are some of the procedures that you will use in evaluating these transactions. And then also can review any confirmation of loans, confirmation of loans received. So the reason why you review this confirmation of loans is for any indication, for indication of any guarantees of guarantees. For example, if the auditor is the one who, if the company director is the one who guaranteed for such a loan that the company has undertaken. So those are some of the aspects I expected you to have in that related party transactions. So once you have identified these related party transactions, you will obtain the relevant audit evidence that the transactions have been appropriately authorized, So that is on the related party transactions, So what you're saying in this case is that the related parties are any entity that can influence the company's affairs. And these are some of the audit procedures to identify, one, the related parties, and then the related party transactions. And the audit work to be done on them would be, so the audit work on this, on related. Now that you have identified them, audit work on related parties and the related party transactions. Now that you have identified these related party transactions, one, you will obtain audit evidence, and audit evidence is said to be all the facts and information that the auditor considers necessary for the basis of an opinion. So you'll obtain audit evidence that the transactions have been appropriately recognized, that the transactions have been appropriately recognized. So that means that they are recorded in the correct amounts. And then also confirm the term and amounts, confirm the amounts by circularizing third parties. So circularizing means you contact the third parties to confirm if the information is actually truthful in nature of those transactions. And then inspect evidence in possession of the related parties. Possession of the related parties. Be it contracts and as such. That is what you're saying. Also, confirm and discuss the information with the third parties, or confirm and discuss the information with other parties to the transactions, For example, the other parties to the transaction. Let's say the directors took out this loan that you're saying in this case. So these other parties, in this case, will say, so you can add there. So for example, the other party will be the bank, to confirm the amount that probably the directors took out on such cases. So also, you will inspect the underlying contracts or agreements, inspect the underlying contracts, or agreements. So the whole essence of inspecting these underlying contracts is to verify that the items of the related party transactions have been authorized. That is what you're saying in that case. So that is on the related party transactions. Now, the other item that we have to discuss also in the same context of audit evaluation and reviews is on what we call the subsequent events. So these events, they are known as the post-balance sheet events. And the reason why they are called the post-balance sheet events is that they occur after the balance sheet date. But before the AGM, occur after the balance sheet date. But before the AGM. But before the AGM. So in between this time, that is what these events are occur. Now, as we know, the auditor is to formulate an opinion and give that opinion in the auditor's report at the AGM. So before that time, there are certain responsibility that the auditor has with regards to the subsequent events. Now, to explain this in a more graphical aspect, so we have the balance sheet date. So the balance sheet date, this is what you're saying, the balance sheet date. And then after this balance sheet date, the audit is completed and the audit report is signed. So we have the audit completion, and signing of the report, of the audit report. So this one is whereby the audit is completed, the procedures are completed and signed off. And then also you approve. So the senior managers of the audit, or the audit managers, the approval and circularization of the audit report, circularization of the audit report, to the shareholders, and to the relevant stakeholders. And after this, now the annual general meeting, so circularization of the audit report and the financial statements also. And then after this, now the AGM is held. Now, between this period, the auditor has certain responsibilities to these subsequent events. And these subsequent events means these post-balance sheet events, and they can be categorized into two. One is known as the adjusting events. Adjusting events. Now, what adjusting events mean? These are events that they provide confirmatory evidence to items that have been identified in the financial statement. So in other words, like the name suggests, they should be adjusted in the financial statement. The adjusting events, they provide a confirmatory kind of evidence to the items in the financial statements. So that is what you're saying. So for this one, provide confirmatory evidence. And in other words, this confirmatory evidence is what are the balances that you're seeing in the financial statements to the condition, to the existing conditions, as at the balance sheet date, So that is these types of adjusting events. Now, some example of this adjusting event would be, for example, in case of a bankruptcy of a debtor, as at the balance sheet date, it means that we have to make a provision for the bad debts. That is what you're saying. Bankruptcy of a debtor after the balance sheet date, it means that our debtors should be corrected or should be adjusted. Also, recovery of a bad debt after this balance sheet date is considered to be also this adjusting event, recovery of a bad debt. It means that we should adjust also the debtor's account in that case also. And then if we sold goods below cost, so sale of goods below cost. If this matter is identified after this kind of a balance sheet date, that is what we call adjusting event. And then also return of goods which had been sold, return of goods. Now, this adjusting events, necessarily you will be asked on the basis of these dates that you're saying here, and we're going to see how that is examinable. So you have to identify what adjusting events are and some of these items. So return of goods sold also, and also any legal litigation that is pending, we have to create a provision for the same. That is what you're saying. Now, the other type of event that we have is what we call the non-adjusting events. So these non-adjusting events, on the other hand, these are events after the balance sheet date that do not concern conditions as at the balance sheet date. So this one, events that do not concern the situations as at the balance sheet date. Now, why this is very important is that if the auditor does not pay keen attention to the subsequent events, it means he will be reporting on items that have not yet been fully either adjusted or disclosed. Now, for the adjusting events, these ones, we make adjustments to the financial statements. For non-adjusting events, mostly we will highlight them as a disclosure in what we call the emphasis of matter paragraph. Now, what emphasis of matter paragraph means, this one we're going to look at it under auditor's report. So this is a paragraph whereby we draw the users of the financial statements attention to the areas that they should also notice about the financial statements that have been prepared. So it is a way to ensure that everything has been properly disclosed as and when the audit was completed. So that is what you're saying, the non-adjusting events in this case. Now, so the auditor has certain responsibilities for this adjusting and non-adjusting events. So the auditor's responsibilities to these responsibilities to subsequent events. So for you to understand this auditor's responsibility in key detail, I want you to look at how these questions are actually set. So you can look at May 2017, question 1 also. So May 2017 also question 1. Also, you can look at November 2015, question 3, November 2015, question 3, November 2015, question 3. So you're given that case there. So you're told, so you are a member of the audit team assigned to audit the financial statements, November 2015. So this is just to show you how these subsequent events are identified. November 2015, question 3. So you're being asked, you're a member of the audit team assigned to audit the financial statements of Elite Trading Company Limited, a listed company for the year ended 31st. So the year of the ended 31st. So the 31st August 2015. And then the detailed audit work is to be completed on 30th October 2015. And then the audit assignment partner has requested to consider the auditor's responsibility for identifying these subsequent procedures, subsequent events and audit procedures for examining subsequent events. With respect to the financial statements of Elite Trading Company Limited, is tentatively proposed as follows. 1, the audit report is to be signed on 12th November, so 12th November, and 2015. And then the financial statements of the shareholders are, the financial statement is to be sent on 2nd December 2015. And then the annual general meeting is to be held on Wednesday, 30th December 2015. 30th December 2015. So you have these dates, and you are told that assess the responsibility of the auditor for detecting material subsequent events in the following periods. So this context, this is what you're saying. For example, you're told that the auditor, the balance sheet date in this case is 31st August 2015. Also, the financial statements are to be sent to the shareholders on Wednesday, 2nd December, and then the AGM is to be held at 30th December 2015. Now, I want to show you how you identify these specific responsibilities. Now, for the first one, between the balance sheet date and the audit completion, or after the balance sheet date and between the audit report is being signed, so that is after the balance sheet date, and between after the balance sheet date before the audit report is signed, before audit report is signed. So in this case, what the auditor should do, one thing is that he should carry out procedures to identify the subsequent events. So he should carry out procedures to identify the subsequent events. So that is on Roman 1, subsequent event. That is the period between that date, subsequent events. Secondly, also, it should ensure that events have been disclosed. So that is A Roman 1 we're saying. So ensure that all the events have been disclosed properly. Ensure events have been disclosed. And those that require amendment, and those that require amendment, those that require amendment have been incorporated, require amendment, have been incorporated, have been incorporated. And then also the auditor, in this case, as the balance sheet date, but before signing of this event, that is what he should carry out. He should ensure that they have been incorporated. And what we mean by carrying out these procedures to identify the subsequent events. So these procedures, in other words, mean one, he can review the budgets and cash flows to have an understanding of either this item is an adjusting event or an adjusting event. Also, he can review and discuss the latest financial statements and read the minutes of the shareholders. So these subsequent events, so the procedures, these ones that you're saying, in this case, you can look at December 2017, which was asked in that case, December 2017, question 5B. And these procedures that you're saying in this case, one would be, so the procedures to identify these, procedures to identify subsequent events include, one is that, so you can read the minutes, or review the minutes of the shareholders, review the minutes of shareholders so that you know if there was any adjusting or non-adjusting events. Secondly, you can also discuss the interim financial statements, review and discuss the interim financial statements So in other words, these subsequent events are those items that can either be adjusted in the financial statements or made disclosures on the emphasis of matter paragraph. That is what you're saying. And then also you can review the accounting records, accounting records of these items as at the balance sheet date. And then, as always, you can obtain written management representation, Now, so that is for the period between the balance sheet date and the audit report being signed, Now, the period between after the audit report has been signed, but before being circulated, is this period right here, this period that you're saying in this case. So we have started with this is the Roman 1. Also, for that one is the Roman 2. That is what you're saying. So the auditor at this point, after the audit report, but before the financial statements, are circulated. At this point, the auditor does not have any procedures, or he has no responsibility to subsequent events. So that is what you're saying. He has no obligation, auditor has no obligation to make inquiries, into the subsequent events or perform audit procedures these audit procedures. And then also the auditor pays keen attention to the subsequent events. So this is what happens. He has no responsibility or obligation to continue with the performing audit procedures, but if he identifies, material misstatements, if he identifies material subsequent events, he should discuss with the management subsequent events. He should discuss with the management. He should discuss with the management if the audit report needs to be amended with the management, if the financial statements should be amended. So if it is material in nature, and we said materiality means what? Materiality is the significance of an item. So if it is material in nature, then they will discuss that with the management. And then if the financial statements are amended, what the auditor should do in this case, the auditor should extend the audit procedures, or the auditor should extend the audit procedures to the amendment, audit procedures to the amendment. So what that means is that the amendment that has been made, the auditor is to carry out also further procedures to verify that actually it is a valid kind of amendment, and it is to incorporate all items identified as the subsequent events in that case. And then thirdly would be the responsibility of the auditor after the financial statements have been signed. After the financial statements have been signed and issued, or have been signed and issued, but before the AGM, because the AGM now is where everything is to be included in this case. So the same case applies at this stage, that he has no responsibility with these subsequent events. That is what you're saying. So for this one, you're saying that the auditor has no responsibility. Just like what we saw in this case. But if he identifies these misstatements or the subsequent events, he should discuss them with the management. He has no responsibility. To identify these subsequent events, to carry out subsequent events. So he has no responsibility to perform audit procedures. To identify this, the subsequent events that you're saying in this case. So during this period, what he does is that if he becomes aware of any material subsequent events, then he has to discuss that with the management on whether they should amend the financial statements. So that is what you're saying. So if he becomes aware of the material subsequent events, one, what the auditor should do in this case. So the auditor should discuss with the management, whether the financial statements should be amended. Whether these financial statements should be amended. And if they are amended now, it should extend audit procedures to the amendments. If amended, should extend the audit procedures, to the amendment. To the amendment also in this case. And then also, because now after these financial statements have been issued, it means that people have the prior financial statements. So if we make any necessary changes, we have to notify everyone who received the prior financial statements. So that is also another thing that he would look into. So he would inquire the management plans. Inquire management plans. Because you have made amendments and we had already issued these financial statements, then he should know the plans of notifying those who had received, plans of notifying those who had received the prior, or those who had received the earlier financial statements, about the changes. So these are some of the procedures that you would have been required also. And then consider whether these changes need to be publicized. Consider whether the changes need to be publicized. For example, if the financial statements are published for the members of the public to see, then you will consider if the changes need to be publicized. Also on the same, to inform every stakeholder of that company. And you will seek legal advice on the same. Now, going back to our question over there, November 2015. So for you as a candidate in this paper, so let's say this one is, let's say these procedures, we are saying this is procedure A, this one is procedure B, or audit procedures and responsibilities, and this is C. So Roman 1, you're being asked from 31st August 2015 to 30th October 2015. So that is the period between which? It is the period between the balance sheet date to when the audit work is to be completed. So which responsibilities are you going to write in that case? Responsibilities A, for this one, you're going to say that he should carry out procedures to identify them and ensure that events have been disclosed on the same. So, and then 30th October to 12th November 2015. So that is the period between when the audit work was completed and when the audit report is to be signed. So that is this kind of procedures that you're saying here, before, after the audit report and before circulation. So these procedures also would happen to be useful because you're saying it is this time that the audit has been completed, also. And then the 12th November to 2nd December, that is the period after the audit report has been signed, but before the financial statements have been issued. So these reports also would be there. These responsibilities, you will state them. So the thing is to identify these time periods, like I said in this case, as the subsequent events. And then thirdly, 12th November to 2nd December, that is the period between 12th November to 2nd December, the period between audit report being signed and 2nd December was the financial statements to be issued. That one is what you have covered. And then 2nd December to 30th December. So that is the period between where the financial statements have been issued and the AGM. So this is that period, the period between this and this. So the auditor's responsibilities will include these points in that case. So that is what you're saying. And then part B, you're asked, explain the audit procedures that you could use to examine subsequent events, the subsequent events. So this is what you would have written to identify those subsequent events in that case. So they're asking for how many, explain the audit procedures you could use in the examination of a subsequent event. So you can also add another one there so that you have the full marks. So it is 10 marks. So you can say also you can discuss with the company, lawyers concerning any pending litigation concerning pending litigation. So this is what was required of you in that case. You will have 15 marks up to that point. So that is question November 2015, question 3, also question 3. So that is on subsequent events. So pay keen attention on these procedures and these dates. Necessarily, you won't be asked on word for word, but as you can see, for this question, you're given dates. So more or less expect the same under these grounds. Now, the next one is on the going concern of a company, going concern. So what we discussed to be the going concern, this is whereby you're saying that the company will be in operation for the foreseeable future, that its operations will continue for the foreseeable future, and the auditor has to look for the indications of such a going concern in this case. So we are saying that this is an assumption that the entity will continue. Assumption, the entity will continue. The entity will continue for the foreseeable future. For the foreseeable future. The foreseeable future, that it won't stop its operations in this case. So the auditor is required to assess the going concern assumption of an entity, and for that, he will consider certain factors that may give rise to a doubt whether this company will continue for the foreseeable future. Now, these factors that may make an auditor doubt this are what we call, so the factors that may cause doubt in audit in going concern, in a going concern assumption will be categorized into 3 ways. Concern assumption. So one of them is what we call the financial indicators. For example, financial indicators. If the company financial indicators. Now, for you as a candidate, you will be required to know these indicators that are, in essence, the examples for them, because they will be asked in form of a case. So in this context, you're saying the subsequent events or the going concern assumption is whereby, so for example, one of the financial indicators that we have is on the net liability. Can the company be able to meet its debts, net liability of the company? So if that is in question, then it means that the company cannot be in operational for the foreseeable future. Also, the operating cash flows, the net operating cash flows, negative operating cash flows, So this means if the operating cash flows are negative, it means that our outflows are more than our inflows. So necessarily we are not making any profits on the same. So the company will not continue for the future. And then also their inability to pay creditors, If they cannot meet their obligations, it means that this company does not have the necessary resources also on the same. And also in the case of adverse key financial ratios. So if the auditor carries out or assesses this financial aspect, adverse key financial ratios, for example, the current ratio, if he sees that or the gearing ratio is too high, or the in terms of the debts that the company has borrowed, then that is it raises the going concern problem that you're saying, the going concern problem. So that is on the basis of the financial indicators in this case. And also you have the operational indicators. So these operational indicators are indicators that affect the business in terms of its operations. For example, loss of a major customer is an indicator that this company may not be in operation. Also, loss of a major personnel without replacement, that questions the going concern probability of this company. So it raises the doubt on the going concern in this case. And then also a denial of a major operating license, like what we discussed, denial of a major operating license, In this case, if you're denied such a license, it means that this company will not be operational for long. And then also in the case of shortage of important supplies that are needed in the organization also. And then also emergence of a highly successful competitor, emergence of a highly successful competitor, So in other words, this is what you're saying. So these indicators will give you an insight of whether the company will be in operation for the foreseeable futures. And then we have the other indicators other than the operational and the financial ones. So for example, any pending legal litigations, also pending legal proceedings against the company, pending legal litigations against the company. And in this case, the company is most likely to pay this person against the company, in which the company is to pay this person, and they do not have that kind of facilities, in which the company is unlikely to satisfy the claims. It means that this company will go under in this case, because if they cannot meet these claims in this sense, then there is no aspect of them being able to operate. And then also if there's occurrence of an uninsured catastrophe, also. So if the business suffers a loss due to an uninsured form of catastrophe also. And then also in the case of changes in law or regulations, changes in law or regulations, changes in law or regulations that may affect the business, in this case. So what then can an auditor do when the audit procedures are in question? Audit procedures when the going concern is in question. The audit procedures to have when the going concern is in question. Now, you can look at November 2015, the same question paper. November 2015, question 4B. Question 4B. November 2015, question 4B. So you are asked, describe the audit procedures that you could perform to assess whether or not the entity is a going concern. So one, you would look out for the indicators in this case. That is what you're saying. November 2015, question 4B. So the audit procedures that an auditor could perform to evaluate this would mean, for example, look out for these indicators that you're saying. Also, he can assess or carry out a review of the key financial ratios, so that he identifies them. So you can write that question there. We will come back to it also. And then what happens if this going concern now is questionable? So one, So the audit procedures to carry out also when going concern is questionable, when going concern is doubtful, the going concern assumption is doubtful, or to assess this kind of going concern. So one, you will inquire about the assessment of the entities going concern. So one, he will inquire, that is what you're saying, in this case, inquire from the management about the assessment, of the going concern, because the management has to make this assessment of their going concern, and if they have carried out an assessment, also, so he would inquire from the management about the assessment of the going concern, and if they have not, he can discuss, if not, discuss the importance of having one, and then if the assessment has been done, what the auditor needs to do is review the assessment, review the assessment. The reason why he reviews this assessment is to see if the company is actually going concern also, or it has its own issues. So once the management has assessed that the company is not going to continue in its operation for the foreseeable future, it is up to the management to come up with what we call the mitigating plans. Now, to explain what mitigating plans are, these are actions that the management will take to ensure that the company operates or will operate for the foreseeable future. That if the going concern is questionable, then the management has to come up with mitigating plans of action. And one of the mitigating plans of action would be, for example, if this financial indicator, if it means that, let's say they do not have enough kind of finances, then they would borrow. That is on borrowing, which we will look at also. They will borrow to finance their activities or to add their activities. And then another key thing, for them to continue operation, they could sell an asset, so that the money that they get from this, they can use to probably pay the creditors and to stay afloat. So as an auditor, he will carry out the procedures or question, what are these mitigating plans that the company has in case the going concern is doubtful? So that is what you're saying. So inquire from the management, their mitigating plans. Also inquire from management, their mitigating plans of actions. Mitigating plans of action. And these mitigating plans of action is to enable the company come back to its feet, or be able to deal with those indicators that you're saying there that will make the company not be in operation for the foreseeable future. So that is on when the company's going concern is doubtful. So these mitigating plans of action, you're saying, so the examples of mitigating plans of action include mitigating plans of action. So this is still under that procedures or processes. It's just to highlight what these are so that you know when you're reading on the same. So for example, they can obtain additional funding, Now you as an auditor, once you know that they are obtaining this additional funding, you have to carry out procedures on the same. For example, if it is a form of a loan, we said when auditing this kind of item from the borrowing, one, you will review the loan agreements. So even these mitigating plans of action, the auditor has to have procedures on verifying those plans of action so that he cannot give an inappropriate review. That is what you're saying. One, he will review the loan agreement on the same and the correspondences from the bank. So one, he will review this loan agreement, loan agreements, and also the correspondences from the bank and the company, and circularize to the lender to determine the amount that the willingness to provide the loan. And then the company can also dispose of some assets so that they have enough cash flows. So this one is to resolve cash flow deficiencies. And what this does is that deficiencies, for example, it corrects this net operating cash flows, but necessarily in disposal, that one also lies in another category of the cash flows. So one of the things that the auditor would do to verify that the sale of the assets is approved. So now this comes back to the procedures that you were saying yesterday. What are some of the procedures on assets, or the audit procedures on assets? For example, for this disposal of the assets, you will first of all do what? Physically inspect that the asset exists. Also, he will do what? Review the legal document to verify the rights and obligation of the assets. So even these mitigating plans of action, the auditor has a duty to them also in that case. That is what you're saying. And then another mitigating kind of action would be, for example, financial strategies. For example, what we call franchising. So the company can be using the brand of another company to benefit from them. Now, such an item, the auditor will look at the minutes of the board meeting so as to know the approval of these strategies, the approval of such strategies. That is what you're saying. And then also they can sell of unprofitable business units. And then also they can do what we call sell and lease back of assets, whereby they sell the assets and then they lease it back for them to use it. So that is what you're saying, sell and lease back of assets, whereby they sell it to another individual and then they lease it now to be able to continue their operations. Also, they can have what we call the financial support from the holding company, and this financial support will now be authorized or stated in the comfort letter, or what we call the support letters, financial support from holding companies, Now, the essence of the support letters, you're going to see this is also asked a lot, the support letters. What do we mean by support letters or comfort letters? So this is a reassurance from, let's say you have a company that is company A, company B. So this is the parent company and this is the subsidiary. So what a comfort letter is a form of a reassurance that whenever the subsidiary is in financial distress, the parent company will eventually come to their aid and actually assist them financially. That is what you're saying, the support letters, which we will look at also when you're looking at the management representation. So these are some of the examples of the mitigating plans of action that the company can actually have. And then also, now on the continuation of those procedures, the auditor can evaluate the feasibility or the feasibility of each mitigating plan. The feasibility of each mitigating plan, And how does he carry out this evaluation? It is through those audit procedures that I have highlighted, mitigating plan of action. Now, this going concern is very important for the auditor because it shows that this company may either be in operation or not. And then also, he may analyze and discuss with the entities the interim financial statements. Analyze and discuss with the management, the interim financial statements, and then what you're calling also the support letters. He may review what we call the support letters, obtain a review of the support letters. So the support letters, in other words, means those assurance, the assurance that the holding company will come to the aid of the subsidiary in any case of financial distress. So those are some of the items that the auditor or procedures that he undertakes in reviewing this, reviewing the going concern of a company, So you can look at September 2021 also. So we are saying obtain and review, the letters of comfort, letter of comfort. So what are these letters of comfort or support letters? So this question was asked. You can look at September 2021 question, September 2021. September 2021, yes, question 2B, September 2021, question 2B. So you're being asked, explain the role of support or comfort letters as evidence in the audit of group of financial statements. So one, you're saying in this case, some of the roles of these support letters. So one, so it proves the ability of the subsidiary with the going concern problem. So one, it proves the ability of the subsidiary to deal with the going concern issues, to deal with the going concern issue. Because we have said that this is a letter of reassurance from the holding company that it will come to their aid. So also, that is what you're saying. Also, another role is that it provides reassurance, for the subsidiary, that the holding company will provide financial support. In this case. So, and then also another importance of this support or comfort letters is that it ensures that the auditor knows that the mitigating plans of action have been set in place for the subsidiaries. So also ensures the auditor understands the mitigating plans have been set, mitigating plans have been set, mitigating plans of action have been set by the management, because we said one of the issues is that it has to state, the auditor will be looking for the mitigating plans of actions, and he can rely on these support letters to know that the subsidiary will necessarily be taken care of in any case of the going concern problem, the such. So those are some of the roles of this support, the roles of the support or comfort letters. And then also it is to be issued for a period, for a limited period, for which the subsidiary is to recover from the financial distress. So that is on the support letters, the support letters, or the comfort letters, what you're calling the comfort letters, So also it provides, another one you can add there, it provides audit evidence, for the basis of an opinion, on the going concern, of the company. And how does it do this? So in this case, so what it does to provide this kind of audit evidence is that, so the audit, the comfort letter, in this case, provides audit evidence. Comfort letter is to be approved through, so the auditor checks on this, is to be approved at the board, at the board meeting, So if it is not, if the auditor sees these comfort letters, then you can know that it was actually approved by these minutes that you're saying also, and it may be limited in terms of the time period. So that is on the comfort letter, and then also it shows the ability of the parent. It shows the ability of the parent company, to support the subsidiary is confirmed. So these are some of the roles of the support letters. In this case, the roles of the support letters that you're saying. So that is on the auditor's responsibility, also relating to this going concern. Auditor's responsibility relating to this going concern also. So this going concern, what the auditor does is that if there are any issues that he has identified, they are to be included in what we call the emphasis of matter paragraph that I had highlighted earlier on in this case. So another thing that we have to also look at on this audit evaluation and reviews would be on the opening balances of the opening balances. Now, for the opening balances, on the other hand, this means you review the opening balances of the accounting period that you're auditing, and it is mostly from the closing or the ending balances. Now, the auditor has a responsibility to this in that, one, so the opening balances. So these are the balances existing as at the beginning of the period. as at the beginning of the period. The beginning of the period. So let's say this auditor is a new auditor of the company. So how then will he verify these opening balances? One, he will look at the working papers of the predecessor auditor so as to confirm that the closing balance is what is now the opening balance. That is what you're saying in this case. So, so that is what you're saying. The auditor's procedures in this case, auditor's procedures in this case would be, for example, you will review the audit work by the previous auditors or the predecessor auditors in this case, the predecessor auditors. So one, review the present of the predecessors auditors, working papers. In any case, if he is a new auditor, and if he's a new auditor also, and then also he can determine whether the opening balance is what was considered to be the closing balance of the last accounting period. So also he can consult with the client's management, with the management, so that they verify these opening balances. Also, he can perform substantive tests on the opening balance, Now, what the substantive test means, this is a test tracing the transactions or trying to see how the opening balances also had been recorded, and then also review the accounting records and review the accounting records and procedures in this case. So this is on the basis of the auditor's procedures on the opening balances. So this is very important because everything is adjusted from the opening balances throughout that accounting period. And then on the basis of comparatives, which are the corresponding amounts and other related disclosures from the accounting period, the auditor should compare this, or the auditor should use this kind of comparatives to know whether the information agrees with that of the prior period and the accounting policies have been adapted with. Now, the impact of this in the auditors is that if there are any items that he should identify, he should state them in the emphasis of the paragraph, emphasis of matter paragraph. So that brings us next to the concept of the group audits. Now this one, the group audits, this is whereby you're conducting an audit of the group accounts, and also this now brings the concept of the joint audit. So when you're talking about the approaches to audit, we talked about the joint audit, whereby you have more than 2 auditors auditing the same client. Now, for example, in the group audit, you'll have what we call the component auditors. And these component auditors are those auditors that belong to probably the subsidiaries and the other types of branches that you have. So the group audit now, in this case, that is what I want us to look at. There are key things that you have to identify in this group audit. So when you're conducting a group audit, first thing is that you have to plan for such an audit and the extent to which you will place reliance on the auditors, on the component auditors. So that is on the group audit. So you're saying this is an audit of the parent company and its subsidiaries. So these subsidiaries may have their own auditors. That is who we call the component auditors in this case. So one thing that you have to know in this case is that you have to come up with what we call the planning procedures or the preliminary planning procedures of a group audit. Planning procedures. So these are the procedures that you are to undertake before conducting this group audit. So one of them will be on the communication on the component auditors of this company. So communication with the component auditors, and that means the component auditors, before you place reliance on this, you will look at the competence of the auditors, the competence of these auditors, also the nature of work or the extent for which they have conducted this work. And then also you will understand the group structure, understanding the group structure. So if we have many subsidiaries or the percentage of the holding company, that is what you're saying, understanding the group structure. For example, if we acquired 70% of this shareholding, how then do we account for such? That is what you're saying, planning procedures. And then thirdly, the auditor, also the auditor of the group, of this group. So he will discuss with the management, discussing with the management on how how they treat their subsidiaries, with the management of the parent companies, on how they identify or account for identify what we call the subsidiaries and also the joint ventures. Identify subsidiaries, joint ventures, and also associates, joint ventures and associates, among others. So this is on the procedures to undertake when you're conducting this group audit, And then also you will check checking the correct classification of the investments, checking the correct classifications of these investments, classification of the investments So for example, the investments into these subsidiaries, have they been correctly recorded? And then also reviewing the register of shareholders and reviewing the register of shareholders and also the shareholders. And then you will also review the prior year working papers, reviewing the prior year working papers. Now this is important for you as an auditor because you will be able to know the high risk areas and the kind of strategy that you are to use to audit this group setting. So we have said that one of the things that you will conduct is you will communicate with the component auditors, but before that you have to assess certain factors before you rely on the component auditors. And what are some of these factors? So when you're relying or using the work of a component auditor, one of the things that you will look at using the work of a component auditor in a group audit, one of the things that you will look at is, so for example, one would be the competence of the auditor, the competence of the auditors, the component auditors, and that brings you back to the qualifications of the auditors. the auditors also. So that is the factors to consider. Factors to consider before placing reliance on this work. So one would be the components auditors competence, and then also whether the component auditor operates in a regulatory environment that actively oversees auditors also. And then also on the independence of an auditor, independence of the component auditors. The component auditors also is independence. And what did we say about independence? What is independence? This is independence is defined as what? This is whereby the auditor uses his integrity, objectivity to formulate an opinion without being biased. Independence, that is what you're saying in this case. Now, another thing that the auditor will consider in this case is whether the group engagement will be able to involve the work of the component auditor to the extent necessary to obtain sufficient appropriate evidence. Also, that is what you're saying, whether the group engagement team would be able to incorporate the component auditor's work, component auditor's work to the extent, or to incorporate the component auditor's work to be able to gather sufficient audit evidence, audit evidence. Now, if they do not have these relevant skills, then the auditor may not necessarily rely on the work of other auditors. And then also, whether the component auditor understands, that he has to relate to the ethical requirements, understands that he will comply with the ethical requirements, that he will comply with the ethical requirements of the group audit, with ethical requirements of the group audit in this case. Now, so that is on the factors to consider before using this work of another auditor or a component auditor. And then also whether the component auditor operates, if the component auditor operates in a regulatory environment, that oversees the work of others auditors, that actively oversees auditors, What this means is that the component auditor has to be within a regulatory environment. In this case, the regulatory environment is the laws, so that he has a form of liability. Because if you are to place reliance on their work, you have to place reliance on someone who is actually having a level of liability in the work that he prepares. He knows that he can be held accountable on the same. So that is what you're saying on this group audits. So on the auditing of these consolidated financial statements, So one of the things that the auditor does when using the work of a component auditor is he will discuss with the component auditors on the business of the entities themselves. For example, the subsidiaries that you're saying in this case. And then also, when he's using this work, he will review the documentation of the auditor. That is why we say that the auditor has to have proper documentation, and then also the significant risks of material statements from these subsidiaries also should be investigated on the same. And the understanding of the component auditor, whether it is necessary to have further audit procedures. So how then does the auditor audit these consolidated financial statements in this case? So the audit of the consolidated financial statements in this case, the audit of these consolidated financial statements, one thing is that he will have to obtain the financial statements, in this case. So you can look at May 2016, question 3, May 2016, question 3. So this is on the auditing of consolidated financial statements, auditing of these financial statements, consolidated financial statements. So this is just to show you that how these questions also look like. So you're asked, describe the matters you will consider. Describe the matters you will consider in the audit of the holding company of Bakari Limited. In the audit of the holding company of Bakari Limited. So one of the items that you will state in this case will be, so the first thing is that you will obtain the financial statements of Bakari Limited and also the component. So obtain the financial statements of the company or the parent company, of the parent company and the components. Secondly, also, because this company, it has its own other components, for example, Makali Limited. So also you will compute the controlling interest of the significant influence, compute the controlling interest of the significant influence, So this is now in the group setting. Every aspect of the group accounts now is in this case. Also, you will verify the parent, verify the parent's shareholding to the register of shareholders. Shareholding to the register of shareholders, of the shareholders. You see, as I told you, part of this audit evaluation comes back to the assertions that we said. For example, computing this controlling interest of the significant influence is to highlight each assertion. It is on the basis of accuracy. Now, verifying the parent shareholding to the register of the shareholding of the investee company, that the name of the parent company is in the register of this other company, because we acquired 70%. Let's say A acquired B, in this case 70% of the shareholding, that the name of A is in the register of the company that we have acquired. This is to verify that this actually this transaction or this kind of item existed also on the same. And then confirming the ownership or the ownership and existence of investment, ownership and existence of investment and existence of the investment by verifying or reviewing, by examining the documents of purchase, by examining the documents of purchase, the documents of purchase, documents of purchase, the documents of purchase of the item that you're saying, the documents of purchase, and circularizing the relevant and circularizing the relevant third parties. So which assertion is this coming back to? The reviewing the documents of purchase, the rights and obligations of this company, who controls the companies that you have invested in, that is on the rights and obligation. And then also you can recalculate goodwill, recalculate goodwill in this case, recalculate also goodwill, like we said. And then also compute the consolidation adjustments, also compute these consolidation adjustments. Compute consolidation adjustments, consolidation adjustments, consolidation adjustments, the consolidation adjustments. And then also you can even check the consistency of the accounting policies across the group, and also obtain the component auditors working papers, auditors working papers. And then also check the consistency in the use of accounting principles, the consistency of the use of accounting policies or accounting principles throughout the group, accounting policies across the group, policies across the group. So this is what you're saying. So that is on May 2016. May 2016, question 3. So like I told you, this area is very examinable also on the same. So you should consider, in this case, when you're auditing these items, you should consider the intergroup balances, the intergroup sales, also the goodwill, and then also the unrealized profits and NCIs, and the NCIs on the same. And the NCIs also on the same. And then also in the differences in accounting policies that have been used, if the group member or the differences, we have said that you check on the consistency of the use of accounting policies. So one, if there is any differences, you will look for the reasons why there is a change in the accounting principles or policies that have been used. And then on the basis of the reporting, these members also, where the members of the group have different reporting dates, special accounts should be created. Special accounts should be created. And then the auditor should also consider on the loss-making subsidiaries and assess the going concern of the same, So one of the events that may lead to many misstatements or the risk of misstatements in this case would be a complex group structure whereby there are frequent acquisition and disposals of this item. Now, also the prior occurrence of intergroup balances would lead to risk of material misstatements, risk of these material misstatements. So another thing that we need to also look at before we look at the audit of specific kind of operations or organizations, for example, audit of cooperatives, audit of banks, and audit of insurance companies. One thing that we have to also look at is you've said one of the procedures that you always have to have in this case would be to obtain the written management representations. Now, these written management representations exist to help the auditor authentify the audit evidence that you're saying. So the written management representations also. So we will come back also to look at the audit of cooperatives, the banks, and the insurance companies. So in this case, the written management representations are very important to the auditor because they assert or they state the material facts of the financial statements that they have been prepared. So for this case, you're saying the auditor obtains this, obtains this written management, obtains written management representation to for items that necessarily he cannot assess himself also on matters that are material, on matters that are material, to the financial statements, in which the auditor cannot obtain or where sufficient audit evidence, cannot reasonably exist. So you will look at this also in detail also. So we are saying that this written management representation, they are those form of representations from the management whereby they help the auditor gather enough audit evidence on the same, on the items that he cannot be able to verify on his own also. So they are very important in an audit of companies. So some of these forms of the management representation, include, for example, representation. One would be a confirmation of, so one would be written statements by the management, provided to the auditors, to confirm matters to the auditors. The auditors to confirm matters, to support other evidence, Now, these written management representations, they help the auditor to have an understanding of what he is reviewing, and then also they may include the relevant minutes to the board, relevant minutes of the board, which we said you have to review also, and written public statements made by the management regarding the financial statements, written statements, public statements, written public statements made by the management, made by the management relating to the financial statements, So these are some of the forms of the management representation. So they have to give this written representation, and some of these elements of a letter of representation include letter of representation. One would be what you're saying, for example, a confirmation about significant assumptions that have been made, also a confirmation about significant assumptions made, For example, when we were saying on the audit of accounting estimates, we said that accounting estimates are necessarily based on certain assumptions. Now, the basis of such assumptions will be stated in the written management representation. That is what you're saying, the written management representation. Also, a confirmation regarding the going concern, status, the going concern status. Also, a confirmation on the related parties transactions, and a confirmation of the disclosure of the related party and related party transactions, So this is what you're saying, that this is some of the elements which we had highlighted. So part of the audit procedures that you're saying, you have to obtain a written management representation are those aspects that they would be included in this case. And then also a confirmation about completeness of the balance sheet item. A confirmation about this completeness. Confirmation about completeness of the balance sheet items. Completeness of the balance sheet items. In this case. Now, so this is very important for an auditor to obtain this management representation, because it gives him this kind of confirmation, for example, on the going concern status. And from this going concern status, he can be able to assess the mitigating plans that he has come up with, the mitigating plans that the company has been able to come up with. So what happens if the management refuses to give such kind of representation? So the auditor has a responsibility in this case to also, so once the management has refused to provide this written representation, one, he would establish the reasons for refusal of such, and then also try to advise the management on the importance of the, or discuss with the management, or try to influence them positively on the importance of the representations made, the representations that have been made, and then also to revalue the integrity of the management. So that is the actions to be taken, in case the auditor, in case the management refuses to give written representation. So one would be, he would want to understand the refusal. So that is what you're saying. So one, you would want to observe the reasons for refusal. Also, he would advise them on the importance of having one, and then seek alternative audit evidence to verify these items in the financial statements. So we will continue from there. We're going to also conduct an audit of the insurance companies, the banks, and also the cooperatives, and look at the same. So this area is examined also a lot, or it is examinable. So you review this, the subsequent events, that is very examinable also, and also the going concern and the related parties also, the going concern and the related parties, and also the group accounts, the group audits. So we will continue from there.